What is up, YouTube? Got some value today. We are going to be talking about crypto. No shit. I'm a degenerate who loves crypto and loves teaching. Hit the subscribe button, hit the like button, and today we are going to be talking about decentralized perpetual exchanges. Super simple, but before we get into that, as always, we got to look at Bitcoin. It is the market leader. So this was one price action structure that we had shown on stream on TikTok, right? It made the new high, higher low, and things are actually looking really good right now. So I am quite bullish on crypto. Ideally, if we want to truly min-max our confidence, quickly zoom out to the daily. We're about to get a new daily candle in 20 minutes, so if we could get a daily candle closure green and break above 28.8 on the daily, confirmation. We're looking good. But all in all, like I've been saying before, time and time again, everything that matters is the stock market. Crypto is just a higher beta alternative. NASDAQ absolutely ripping green dildo mode. So no reason to be bearish. With that in mind, today's video is going to be talking about Operation Choke Me Daddy, Operation Choke Point, and the consequences of this. So for those who don't know, the American banking system has kind of been shutting out crypto-friendly banks, and this has major implications for just how accessible crypto is. We're also seeing major conglomerates like Binance go under the CFTC or get attacked by the CFTC. We've seen FTX become insolvent. And so overall, the USA is very quickly becoming a non-friendly crypto place. I think there's major consequences of this, but Operation Choke Point was the buzzword for what happened back in the early 2000s regarding gun control, and Operation Choke Point 2.0 is the same thing, but crypto style. So American regulatory scene, super unclear, and I think there's major consequences for this. Just reading a Binance article here, Asia leads crypto regulations, innovation may leave the US. So this was a quotation from a Ripple employee, and I think it's true. I don't like Ripple, but I do like what he has to say. This lack of regulatory clarity is going to have major implications for US crypto innovation, and I think ultimately a lot of companies are just going to leave. Maybe it's a power control dynamic with looming CBDCs, but it does seem like the US is losing the space race. Ultimately, there is a very large market to capture here. So I think that the more unclear and the lack of regulation pushes a different kind of product in the crypto sphere. Specifically, I'm talking about DeFi. Obviously, one of the best tools to analyze DeFi is DeFi Llama, right? This can show you total value locked, all these great metrics to try and help you understand the market better. And let me see if I can show you guys this. So total value locked right now, it's like 50 billion, just a fraction of what it was back in 2021. Lido clear winner, but one thing that I want to state, usually the higher the market cap, the lower the upside, right? So when we look at Lido, Uniswap, PancakeSwap, all these big projects, they have limited upside because their market cap is already sustained so much. So with that in mind, we have to find a way to find value. And so when we're looking at these crypto projects, I think there's two niches in DeFi. There's inflative coins, which take people's liquidity, provide a service to the market, and they inflate their own token, or there's real yield. So, quick sip of Coke Zero. And if you didn't know already, I do all these YouTube videos in one shot, so it's very common that I get out of breath. So let's use PancakeSwap as an example. 40 cake minted per block, right? This gets distributed to the people participating in the cake ecosystem. But the problem with this is the only way for them to extract a non-risk associated dollar-denominated value, as in they get paid in cake, but if they want to extract the value out of that cake, they have to sell. Or they could reinvest into a liquidity pool, but ultimately if they ever want to extract the value out of cake, they gotta sell cake. This is true with PancakeSwap, this is true with Trader Joe, this is true with Uniswap, this is true with any token that inflates their supply to pay users. Plain and simple. So this is what I think classifies as an inflative DeFi project, and fundamentally the upside to these is very limited because of tokenomics. So just to ensure that I'm unbiased and provide both sides of the story, let me see if I can get this over here. These projects usually do usually do have a deflation mechanism integrated. So for example, it burns for every trade, it burns on a subsidiary stable swap, burns 100% of the participation fees for IFOs. Like, there is mechanisms to reduce outstanding supply, but the higher the outstanding supply and the higher the emittance, the lower your retained value as a liquidity provider. So that begs the question: if this is inflative yield mechanism, what is real yield? Welcome to GMX. So GMX is a perpetual exchange. So think Bybit, BitMEX, OKX, even Binance offers futures. These are platforms where users can trade derivatives, but instead of a company facilitating that trade, it's a protocol. Major implications. So for example, GMX, it is both a website and a token. If you buy the token and you decide to stake it, you get to participate in governance, and you also get 30% of the fees that GMX generates. And fundamentally, what separates this from an inflative token is GMX pays those fees in Ethereum or Avalanche, depending on which network you're connected to, because GMX was the flagship product of the Arbitrum ecosystem. So if you're on the Arbitrum ecosystem interacting with GMX, you get paid in Ethereum. If you're on GMX on Avalanche, you get paid in AVAX. So this is where the buzzword real yield comes from, because GMX offers a service, decentralized perpetuals, that have fees associated with trading them, because you can access up to 20x leverage on this platform and trade a couple different cryptos. So it's a decentralized alternative to those who are maybe blocked from services like Bybit, can't access it in their country, it's blocked by the internet, regulatory reasons, etc., etc. Or maybe you don't want your exchange counter trading you like Binance does. Protocols are transparent. So similar to how you can provide liquidity to PancakeSwap, there is another liquidity mechanism called GLP. So basically you buy GLP and you essentially buy a slice of a bigger pie, so you can deposit something like USDC into GLP, and you're providing liquidity for exchange operations. In exchange, you get 70% of fees. So you may notice 30% of fees go to GMX holders, 70% of fees go to GLP holders. Very little, if any, is retained by GMX protocol. The other thing that you should be aware of is traders can use GMX for spot, swap, and margin trading. As shown on this diagram here, they pay the fees to GMX, which is redistributed. But when you enter GLP, you're technically counter trading the traders. So if it's a bull market and it's up only mode and traders are making a lot of money, that actually comes out of GLP's market share and vice versa. That being said, the house usually wins. Most derivative traders are intellectually disabled. Do with that information what you will. So now we understand the difference between inflative yield and real yield, hopefully. And if you don't, watch that video again and take some notes. So this is DeFi Llama again, super great resource. Over here, we sorted by derivatives. So these are all the derivative platforms. So basically what we're looking for, there's total value locked metric. Sorry, I'm just trying to figure out how I can show you guys this. There we go. So GMX, total value locked, 620 mils. So that is the amount of money in the ecosystem. DYDX, similar story, pretty much just under half. And you can see that there's a major drop off as these go down, right? So you could say that GMX and DYDX, as well as Gains Network, have the largest market share of this niche, derivatives. I think this is a narrative that is yet to play out, but will become stronger the worse regulatory clarity or regulatory intervention gets in the States. America. So looking at this metric, pretty clear to see. GMX, DYDX, Gains Network, GMX and DYDX, big winners here. It's also on DeFi Llama, we can look at fees. So this is the amount of revenue that is paid in real yield to stakers. So we can skip past this, fees. So there's a couple metrics here. Fees versus revenue. Fees are the amount of money distributed to, the amount of fees that are paid to the protocol. Revenue is the amount distributed to token stakers. So If we're looking at fees, then it's 535,000 ish. 30% of that, which is 160,000, gets paid to GMX stakers, and the rest would get paid to GLP stakers. Similar story with Gains Network, right? That means it accrued $75,000 in fees over 24 hours, and it paid out $55,000 to stakers. So this is real yield, and more or less, most of these projects distribute fees to their users rather than inflated mechanisms. Now, the real alpha. What we want to do is we want to find higher market cap projects because that implies more or less that they have a larger market share. You want to see a rising total value locked because that means increasing confidence. But most importantly, you want to see good fees and revenues because that tells you that the exchange is actually making money. So there's a couple things I want to talk about here. When we look at the total value locked, you may notice this is sorted high TVL to low TVL. There was a name that popped up here, Level Finance. So it is quite low in total value locked. It's only at 26 million, but if we look at fees, it's number 2. It's number 2. It is the second highest fees generated in 24 hours, but by total value locked, it's the 7th project. So you can pause, read this if you want. I got ChatGPT to summarize all the tables, and I'm just going to tell you about it. Basically, what you want to find are I'm not going to tell you actually how to do this or what the actual results are because that might be financial advice, but what you can do is you can take fees paid out, 7-day average, more reliable, divided by total value locked, and that's going to give you a ratio to how much is paid to stakers versus how much is actually in the ecosystem. And if you do that math, you can come to the conclusion that, hey, maybe there are some projects that should be paid attention to in no particular order. Essentially, I do not think this narrative is played out because there is impending regulation in the states that is going to push people to decentralized alternatives, and you can't beat the passive income that these projects generate. So, this is not financial advice, but I know personally, I have been in GMX since August, July, something like that. I've also been in GLP getting that sweet yield, and I know moving forward, there's another project I might be bidding large size into. But hey, do what you want. Stay safe, take care. Thank you for watching.